Since 1965, Warren Buffett, the world's best investor, has been laser-focused on buying individual stocks and trying to outperform the market for the benefit of Berkshire Hathaway's shareholders. He has done so very successfully, with an average annual return of 20 compared to the S&P 500's rough 10. However, he does not recommend that most people do what he does. Instead, he proposes that the majority of individuals subscribe to passive investing and simply dollar-cost average into an index fund that tracks the market. Welcome back at Financial Fortune, your daily advisor that gives you news and tips for financial success. Just keep on watching.
There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. There's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is.
In 1974, he established the Vanguard Group, which we all recognize today, and in 1975, he developed the first index fund for private investors, the Vanguard 500 Index Fund, which intended to replicate the performance of the S&P 500 index. This represented a drastic break from the prevalent investment philosophy of the time, which stressed actively managed funds that sought to outperform market averages through stock selection and market timing. Bogle believed that the majority of actively managed funds underperformed the market due to excessive management fees, and that index funds were a more cost-effective and efficient way for individual investors to receive respectable market returns.
People should take an index fund for what it is, Tyler. This is a large cap-oriented fund. There will be a time when small cap and mid cap funds will do better than large cap stocks, but it's not here now. And to my delight, it wasn't here in the decline. The index fund gave a wonderful account of itself when the market went down mid-July to the end of August.
Hey, Mr. B, Bill Griffith here as well.
Hi, Bill.
What about the big picture, though? I mean, you, more than anybody probably in the mutual fund industry, have been a proponent early on of index mutual funds, and people lately have been buying into them. But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
You know, we were talking last week on the program about mutual fund fees, how most people are happy to pay them when the market's going up because they're still making money. But as the market comes down, and especially as the net asset value of a mutual fund comes down, people maybe start to pay more attention to those fees, something that I know is very near and dear to your heart.
Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.
You think they're going to have to come down, though, because of competitive practices and because maybe fund investors will demand it?
I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that.
In addition to fees being, as your word, outrageous, a lot of people think that there are just plain too many mutual funds out there, some 9,000. What's your view on that? And I note that you guys have something like 22 or more separate index portfolios just in the equity area. Why do you need that many?
Well, you need, first, I think there are far too many funds in the industry. I mean, I don't know what one does with 9,000 funds. Now, of course, I can immediately jump to our own defense, which maybe is a little bit unfair, but you need a number of index funds because investors are getting more specialized, and some investors want the 500. My preferred index fund happens to be the total stock market, which includes large, medium, and small stocks, but some investors with a blue chip portfolio want an aggressive entry into, say, small cap growth funds. Well, a small cap growth index fund is a very intelligent way to do that. So, to a point, we ought to meet public demand. We shouldn't be creating, we as a company or we as an industry, mutual funds whose only reason for being is to appeal to a marketing need that is unsound. We ought to be spending more time in this business on investing and less time on marketing.
Many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but the truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him, and he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds, and we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time.
Why then does he believe that the majority of investors should dollar cost average into an index fund? He believes that the most crucial trait for an investment manager is temperament and not intelligence.
I really thought that maybe we were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
As Warren stated, All you needed to believe was that the American economy and American business would continue to advance over time, and for passive investors, the less they pay attention, the better it is. Overall, this is the reason why the finest active investor in the world advocates passive investment. But there are always risks associated with stock market investing, and this video is in no way a recommendation for you to buy anything. For instance, there is always market risk when you have a diverse portfolio, as well as concern from astute investors such as Michael Burry. For example, index investing is removing price discovery from stocks, which means their respective market caps are no longer being set by underlying business performance, which means a bubble is forming. It's also important to remember that these index funds are programmed to only buy the largest companies in a particular market. But if you hold the largest 500 stocks in America, you will own the largest 500 companies in America. For instance, there are likely to be some companies in there that don't line with your values and beliefs. So there's still a lot to think about before you declare yourself a passive investor. Hopefully, you now have a better understanding of passive investing and why Warren Buffett recommends it to the majority of investors. If you found it helpful, please click the like button. If you wish to view other videos like this one, please subscribe.